Later today, we get the latest release of the Fed minutes. As a refresher, the Fed went ahead and raised rates 25 basis points following a brief pause in June. Resilient economic momentum, a tight labor market, and cooling inflation have all factored into the latest slowdown in Fed tightening. The big question now is whether this slowdown in rate hikes will lead to a complete pause. And if the Fed does, in fact, look to pause rates, how long will it be before the Fed considers a move towards rate cuts? At the latest press conference, the Fed chair stressed the importance of economic data as a determinant in the direction of monetary policy. And since then, the market has interpreted this to mean a Fed that is enough reason by way of the data to head towards a sustained pause. Fed futures currently show an implied probability of 90% for a pause in September and a 65% probability for a pause in November. We have been getting a lot of mixed signals from within the Fed, with some officials leaning more hawkish and others leaning more dovish. So it'll be interesting to see what we get from today's minutes. On the whole, the theme that seems to be more present in 2023 is one in which overall the market has pushed for a more dovish leaning Fed, while the Fed has more often than not let down dovish market expectations. And so, as far as today's minutes go, should the communication be one that leans more hawkish, leaving the door open for more rate hikes, we would expect to see more downside pressure on stocks and demand for the US dollar, both on a yield differential and flight to safety implication. If, on the other hand, the Fed satisfies market expectations leaning more dovish, look out for a quick rebound in stocks and sell off in the buck. We still feel the Fed is not yet ready to be as dovish as the market would like to see, leaving the door open for some risk off flight to safety flow in the aftermath. Let's see how it plays out.